Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a story that's been making waves in the financial sector. IFC subsidiary, IFC Financial Services, LLC, has been ordered to pay over $800,000 for allegedly failing to supervise its employees' handling of customer accounts. According to reports, some clients were subjected to unauthorized trades and other forms of misconduct. However, we also want to bring to your attention another interesting development in the world of finance. Nitin Rahija, an expert in the field, shared his insights on the current state of Indian equities and the expectations from the union budget. He believes that while some sectors like EMS have seen a huge sell-off, they may still have room for growth in the long term. On the other hand, financials have been market leaders, but their earnings and valuation premium going into FY27 may not be sustainable. Rahija also emphasized the importance of capital expenditure in driving economic growth, particularly in an increasingly fractured and tumultuous geopolitical world. He noted that to attract foreign flow, India needs higher growth to justify its present valuations. It's essential to consider multiple perspectives when evaluating investment opportunities. We'll continue to monitor these developments and provide you with balanced analysis to help you navigate the complex world of finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. Today, we're exploring a significant development in the fintech sector, where traditional banking meets innovative software solutions. The story that's caught our attention is the acquisition of Brex by Capital One, a deal that signals a new era in business finance. Now, let's take a closer look at what this means for both parties involved and the broader fintech landscape. Brex, founded in 2017, has been a standout in the fintech space with its corporate card and expense management tools designed specifically for startups and tech companies. Its reputation for offering flexible financial solutions without personal guarantees made it a favorite among entrepreneurs. However, as the fintech sector faces tougher conditions due to slowed venture funding and rising interest rates, strategic acquisitions like this have become an attractive path forward. Capital One's move to acquire Brex is about more than just expanding into corporate cards. It's about software, automation, and how artificial intelligence is transforming financial operations within companies. Brex has positioned itself as an AI-native finance platform, focusing on tools that automate expense reviews, enforce spending policies, and reduce manual work typically handled by finance teams. This alignment with Capital One's technology-forward approach is key to understanding the rationale behind this acquisition. By acquiring Brex, Capital One gains a ready-made software layer designed around how companies manage spending rather than traditional transaction processing methods used by banks. This deal reflects a growing focus on automation and AI in back-office work, aiming to guide and control spending in real time, not just track it after the fact. For Brex, this acquisition provides access to Capital One's infrastructure, resources, and customer base, allowing for expansion beyond its current market. The implications of this deal are multifaceted. It points to a larger shift in how financial services for businesses are evolving, with corporate cards becoming part of broader software systems that manage budgets, approvals, and compliance automatically. For the fintech industry, it suggests that partnerships and acquisitions with established financial institutions may be the next phase of growth. In conclusion, the acquisition of Brex by Capital One is a significant indicator of where business finance is heading, towards more integrated, automated, and AI-driven systems. As we watch this space evolve, one thing is clear: the future of fintech is about collaboration and innovation between traditional banks and tech-forward startups. Welcome back to the Riskwiser Zone. As we wrap up today's episode, I'd like to leave you with a thought-provoking story about the power of patience and experience in investing. Mark Keller, CEO and Chief Investment Officer of Confluence Investment Management, recently shared his reflections on the lessons he learned from Warren Buffett's letters and the wisdom of his former colleague, Boyd Poston. Keller notes that Buffett's letters were like a graduate-level education in understanding what makes one business better than another over time. He emphasizes that successful investing is not about guessing which businesses will do well in the short term, but rather about identifying companies that can thrive for decades. This approach is echoed by Poston's aphorisms, such as, "Never invest in a company whose CEO has a deep tan. He's not spending enough time at the office." The key takeaway from Keller's story is that patience is a virtue when it comes to investing. As Benjamin Graham once said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." This means that while the market may fluctuate in the short term, ultimately, it will reflect the true value of a company. Keller's experience and the wisdom of his mentors serve as a reminder that investing is a long-term game. It requires discipline, patience, and a deep understanding of the businesses you're investing in. As we navigate the complexities of the market, it's essential to keep these principles in mind and avoid getting caught up in short-term hype or impulsive decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.